Hello managers, this is Accounting 101, Lesson 1. And the focus of this lesson is going to be on accounting equation. Alright, so there are three things which are very important when you deal with accounting equation, as we have discussed in the free session which I hosted that explained everything about accounting equation. But I'll just do a recap even over here. So we have three accounts which will have to balance. Alright, you have the asset having to balance with the equity and liabilities combined. So something to remember about assets accounts is that they increase on the debit side. So when you debit an asset account, you are saying that that account is going to increase. For example, if you receive money in your bank and your bank is an asset account, that means you're going to debit bank. Alright, so if you look at the general ledger there, it's written account debit on the left side and then account credit on the right side. Alright, I'll just highlight right now. Account debit there in yellow, and then account credit there in green. Alright, so if you're receiving money in your bank, then you'll have to debit the bank because it's an asset account. However, if you're buying something on credit, then your liabilities are increasing, right? Obviously, you will record that under creditors control, where you record all things that you bought on credit. So that means you will credit creditors control, and liabilities increase on the credit side. All right, the liabilities increase on the credit side. So you will write the account in the green column there. That's how we're going to do all of these things. All right, so I'll just keep the colors there just to be used as a reference. All right, I'll keep the colors there just to be used as a reference. So I'll also shade this green just as a reminder. Okay. Now another thing to take note of is if you check here whereby we have red color, the red box, it says 0, and on the left side it's written balanced equation checker. So we're going to use this to see if our calculations are correct and our accounting equation is balancing. As long as that number is 0 there, it means whatever that we are doing is correct. Okay, so let's start with the question. So the information there says Kingfisher Enterprises is a local company selling computers and computer parts. All inventory is sold at 35% markup on cost. This means if you buy something for 10,000, you're going to add 35% on top when you sell it. All right, that's what 35% markup on cost means. Now, the following transactions took place during May 2022 for Kingfisher Enterprises. Ignore VAT. The first transaction there says purchased trading inventory from Bengaluru by gains on credit 56,438. Okay, so let's analyze the information. The company purchased, all right, they purchased what? They purchased inventory. Okay, what is inventory? Inventory is an asset. So that means an asset is going to increase. And then where do inventory or an asset increase? Asset increases on the debit side. but they bought this on credit. All right, they did not pay for it. That means our credit is increasing. All right, and then where do our credit is going to be recorded? It's going to be recorded in the creditors control. And this is a what? This is a liability. So this is also going to increase, and liability increases on the credit side. All right, so the amount is given. So we're just going to go to our table there on the yellow side. That's where we are going to write inventory, because that's an asset increasing on the debit side. And then in the green box, we're going to write our creditors control. All right, and then we're going to go under assets. Then we're going to record 56,438. Going to record 56,438. And then the liabilities as well, we're going to record 56,438. All right, so if you look at our balanced equation checker there, it is still equals to 0. So it means whatever we are doing is perfectly fine. All right, whatever we are doing is perfectly fine. Okay, I think that's a bit better. So if, for instance, we do something incorrect, we're at minus, we say the liability is going to decrease by 56,438. That's what's going to happen. You see our balanced equation checker there. It's not 0, it says 112,876. All right. So it must definitely be the correct input. So we are done with the first one there, number 1. So we now go to number 2. Number 2 says paid monthly rent 18,450 via electronic transfer. Okay, now we must analyze the transaction. The key term there is paid. All right, is what is paid. If you have paid, it means money has left account. All right, it means money left the bank account, and then we know that bank account is an asset, and this money reduced or decreased the asset, and then the bank or the asset decreases on the credit side. So what was paid or what was settled? It was the rent. Okay, so rent is an expense which is going to be affecting the equity. Right, it's going to affect the equity. Right, it's going to reduce the equity. And we know that our equity is going to decrease on the debit side. Right, it's going to decrease on the debit side. So you'll come here, and then under your account debit, that's where you're going to write the rent. and then under the account credit, that's where you're going to write the bank, and the amount was given to us as 18,450. So the assets will decrease, so you'll say minus 18,450, and then the equity as well will decrease. We'll say minus 18,450. You see there our balanced equation checker, it remains 0. Alright, so let's check the next transaction, which is number 3. It says we have sold goods on credit to Lower Shen for 34,425. Okay, again, let's analyze the transaction. So always very important to analyze the transaction before you even write into your accounting equation. Just try to be just use common sense every time you deal with these things, and they will make sense most of the time. You don't have to complicate the approach. All right, so just a reminder of the transaction. Said we've sold goods on credit to Lower Shen for 34,425. So what happens here? We sold goods, right? And then if you sell goods, that means you're making money. All right, the only difference now is we did not sell for cash, so we did not receive the money. That means our bank account won't be affected because we did not receive cash. Right now, if someone was to buy things from you but does not pay you immediately, it won't show in your it won't show in your bank account, right? But you can just create a small account where you can keep track of all things that you sell on credit, and you can call that account debtors control. And then you tell yourself, I'm going to record all people that owe me under this debtors control. So this debtors control is going to increase. This debtors control is an asset. All right, so it's going to increase on the debit side. Okay, very key to understand that. And then what other account is going to be affected? That is sales. All right, that is sales. And then sales is going to increase on the credit side. Okay, and that is because sales is an income. And then we did say at the beginning that expenses and income are recorded under equity. So that is because sales is an income, so it's going to increase on the credit side. Remember, equity increases on the credit side. Okay, so the debtors control is going to increase by how much? By 34,425. And then also the sales are going to increase by 34,425. I think we all know the sales account. When you prepare the income statement, you will start with the sales there. All right, so we now go and record. So remember the account to be debited, it is the debtors control, and then the account to be credited is the sales. Okay, so we're going to have there 34,425. you will see that the balance equation checker is still 0. So it means everything we have done so far is correct. But then you're not done yet with the transaction. And why is that? That is because in any business, all the stock at hand is recorded for many reasons, and one of the reasons is keeping track. All right, because you don't want to find yourself without stock and having to tell your clients, no, we don't have this stock. So you always want to have stock in your business so that when clients come, they can be attended to, right? They can be sold whatever it is that they want to buy. That is one of the reasons you have an account that keeps track. But also, another important reason is to ensure that stock is not being stolen. If you did not record stock, it will be stolen, and you won't see the difference. When it is being stolen, you won't realize, because there is no way you keep track or where you record. If you have a business and you record, and then you come to work and then you try to count the stock, and then last night when you recorded, it said there's 12 units of stock left. This morning when you open up, it's only 10 units, and in your books it says 12. Then you'll be able to see that someone stole. All right. So right now, no one stole. We sold some stock. So we have to update into our books to say that some stock has left the business. So which account do we have to update? We have to update the inventory account to say that stock has left the business. All right. Inventory account is an asset and it's decreasing. So it's going to decrease on the credit side. But then also remember, this stock, when we bought it, we had to record it in inventory, right? But now we also have to record it under cost of sales. All right, how much did this sale cost us to buy and then come to sell? Right? So cost of sales is going to increase on the debit side. All right, it's going to increase on the debit side. All right. Oh no, I made a mistake there. It's going to decrease on the debit side. Yeah. So now these are the amounts that we have, the 34,425. But remember, this is not how much we bought the stock for, because we had to make a profit. All right, this is not how much we bought the stock for, because we had to make a profit. And then how much profit did we make? If we go back to this information here, it said to us, Kingfisher Enterprises is a local company selling computers and computer parts. All inventory is sold at 35% markup on cost. So what this means is that they took the cost and then they added 35% on top, and you can say markup, and then they got the selling price. Okay, it's like when you buy Tupperwares and then you have to add a percentage on top before you sell. You buy your Tupperwares for 500, you add 10%, then you sell them. They did the same thing here. So Now we want to know the cost. So to find out the cost, you'll simply say selling price divided by 1 plus markup cost. What is the selling price? Selling price is 34,425. 34,425. What is the markup cost? 35%. All right. And that is going to give us 25,500. So in our books, that's what we're going to show. We're going to show that the inventory has decreased by 25,500. All right, and the cost of sales as well has decreased by 25,500. So remember, you're going to debit the cost of sales and then credit the inventory. Okay, then you're going to say minus 25,500. So if you look at the balance, the equation checker there, it's not zero anymore, right? And if by any chance we make a mistake and say 25,500, it's not going to be zero. So we must have the correct input to say that the equity is going to decrease by 25,500 because cost of sales is an expense account, right? It is showing us that we spent some money on things. All right, we are done with the third transaction. We now go to number 4. Number 4, it says the owner B Bengaluru made a capital contribution to increase his capital from 158,000 to 250,000. This was done by means of an electronic transfer from his personal account to the business bank account. All right. So the owner has a capital account, all right, which is under the equity, right? And then when he transfers money, it's going to go into the bank of the business, which is the asset. So the asset is going to receive some funds. It's going to increase on the debit side. The equity is going to increase on the credit side. So we know that the capital and the bank are both going to increase. By how much? That's what we have to calculate. So initially, he contributed 158,000. Right, just a reminder. It says there he increased his capital from 158,000 to 250,000, and then it went to 250,000. So we must get the balance or the difference between these two amounts. So we'll simply say 250,000 minus 158,000. And that is going to be 92,000. So he added 92,000 more. Okay, he added 92,000. His capital increased, his capital account, and then also the bank received 92,000 of investment. All right, so we're going to have an addition there. So what's going to increase is the bank and the capital, whereby you're going to have 92,000, and then the equity also increasing by 92,000. So you'll see that the balance equation checker is moving right back to 0. Then let's check the next transaction. Next transaction says paid wages of 9,840 rands. This was done by drawing cash from the business bank account. This transaction here, I believe, is very, very clear. The bank account is going to decrease because we went and then we withdrew some money. So the bank account, which is an asset, is going to decrease. And it decreases where? On the credit side. And then our wages which are an expense. Remember, when you prepare income statement, you write the wages under your expenses, right? And we agreed that expenses, they decrease on the debit side, which is the equity. You're going to have the expenses there, right? You're going to have the expenses there. That's where we're going to write the expenses, right, on the debit side. Right, I meant to check the amount, 9,840. Right, you're going to have 9,840. 9,840. All right, that's how you're going to record that. So it will go there, and then you'll have the wages, and you will have the bank, 9,840. Is going to be a decrease, right? So minus 9,840 minus 9,840 is an expense. All right, we move to the next transaction. Number 6. It says we received an invoice for repairing the printer. The invoice is 3,981. The invoice was paid by electronic transfer. It is company policy that repairs are not capitalized. So a printer of the business was broken. All right, and then we went to this shop that fixes the printers. They fixed it, and then after fixing it, they sent an invoice to us to say that we owe them. We owe them how much? 3,981. And then the company decided that we must pay it. All right, so we paid using electronic transfer. So that means our bank account, which is an asset, is going to decrease on the credit side by how much? By 3,981. And then what is this? This is a repair, right? A repair is an expense, which is going to decrease on the debit side, which is the equity. So 3,981. All right, you go into debit. the repair, which is an expense. So it means it is decreasing. And then also the bank is going to be debited, so it's going to decrease. How much? 3,981 minus 3,981 minus 3,981. The balance checker there, it's 0. So we now move to number 7. It says cash sales 12,015. The amount was banked on the same day, so our bank is going to be affected because it received money. Okay, bank is going to increase on the debit side by how much? 12,015. And then what else? It is sales, right? Sales account. Sales account as an income is going to increase the credit side. 12,015. So let's record this before we continue. So we're going to have the bank and then sales. So bank is going to increase by 12,015. The equity as well, 12,015. But remember what I said last time, that every time stock is sold, there's many accounts that must be updated. One of the accounts that must be updated is the inventory, which is an asset. We must show that some stock has left the business so that we don't suspect someone stole them, right? So we must credit. How much must we credit? We must credit by the value of the stock. So let's calculate the value of the stock. You still remember, we have this formula here, and then we know that on every single inventory of the business, we add 35%. All right, we add 35%. So we're going to come here, then we'll say 12,015 over 1 plus 35%. And that is going to give us 8,900. So the stock that has left the business is worth 8,900. Of course, we must not forget cost of sales, which is going to be debited 8,900. All right, so we'll debit cost of sales, and then we'll debit inventory. So we'll have there minus 8,900. You'll see the balanced equation checker there just moved. Then we'll have again minus 8,900. The balanced equation checker is back to 0. So everything we've done so far is correct. And then the next transaction says we have purchased a computer for use in the office on credit, 15,999. All right, this is for use, so this means it's an equipment. And then we know that in our balance equation, the equipment appears under assets. All right, so we bought a computer, which is an equipment. You can just write the computer, and then since this is an equipment, we know that it will fall under assets. So basically our asset account is going to increase by how much? 15,999. And then we bought this. If you buy something, you expect your bank account to decrease, right? But in this case, we actually bought it on credit. We did not use cash. So our credit is going to increase. What is our credit? Our credit is a liability. Liability increases on credit side, right? Just a reminder. If you still remember, under the green block there, you'll see credit liabilities increase on the credit side. All right. So what is this account? It's a creditor's control. Right, it's creditor's control, which is a liability. And it's going to increase on the credit side by how much? 15,999. All right. So you're going to go here, and then we will have the computer, and then we will also have the creditor's control. It's going to, so our assets is going to increase by 15,999, and then our liabilities are also going to increase by 15,999. And just like that, you move to the next transaction. So number 9 says that we have received a payment from a debtor of 2,500 as a payment on his account. All right, so a debtor is a client, right? A debtor is a client that owed us money. A debtor is a client that owed us money. So we used to record under debtor's control that so and so owe us money. So this so and so has now come and gave us the money that they owe us. So we must go back under debtor's control and update to say that so and so has paid us. So the debtor's control is going to decrease by how much? Number 9 there, by 2,500. All right. So debtor's control is an asset. It's going to decrease on the credit side by 2,500. And then what else is going to be affected? Of course, the person gave us money. Money will reflect in our bank account. Our bank account is an asset. It's going to increase on the debit side. By how much? By 2,500. All right. The bank is going to increase. And then the debtor's control is going to decrease. By how much is the bank going to increase? By 2,500. And then the debtor's control is going to decrease by 2,500, which is an asset. So we'll see minus 2,500. So two assets were affected at the same time. That's why it's going to appear only under the asset. Remember, we cannot show it under sales again because it was already dealt with previously when the sale took place. Then number 10 says the owner took 500 from the petty cash for personal use. All right, for personal use. Now the petty cash is an asset. All right, the petty cash is an asset, and the asset is losing money in this case because the owner is taking money. So asset is going to decrease on the credit side by how much? By 500. And then the drawings, which are an equity, are going to reduce on the debit side by how much? By 500. All right, so we're going to have to record there drawings, and then petty cash. So I'm going to say minus 500 minus 500. So you can see there our balanced equation checker is still 0. Then we go to the last transaction. It says settle the account of Bengaluru bargains in full. No discount is allowed, and the balance on this account at the beginning of the month was 2,780, being an amount short paid in April 2022. So remember, the first transaction, it says we have purchased in trading inventory from Bengaluru bargains on credit. So we went to this shop called Bengaluru, and then we bought stock that is worth 56,438. All right, 56,438. All right, we went to Bengaluru, and then we bought this on credit. The statement also says that at the beginning of the month, there was a balance of 2,780. There was a balance of 2,780. Right, this is at the beginning of the month, and this is during the month. So that means we owed them total of this amount. Right, we owed this company there 59,218, and then all of this was recorded under creditors control, because that's where we record all the amount of money we owe people. It was recorded under creditors control. All right, so we must update the creditors control, which is a liability. Must update this liability here to say that we are going to reduce you by 59,218. All right, we're going to reduce you by that amount. All right, and then also the bank account, money is going to leave the bank account. How much is going to leave the bank account? 59,218. Remember, bank decreases on the credit side. All right, and then creditors control decreases on the debit side, because it's a liability. All right, because it is a liability, decreases on the debit side, and then the bank decreases on the credit side. All right, so you're going to come here, and then you'll have creditors control there decreasing, and then you will have the bank there decreasing by how much? 59,218. So you'll have there minus 59,218 assets decreasing, and then also liabilities minus 59,218. Okay, so we have our totals there. The total for assets is 84,488. I'll just highlight there in sky blue. That is the total for assets, and then the total for equity, so 71,269, and then the total for liabilities, 13,219. So these amounts must balance. Okay, we can just check. Remember, the accounting equation states that assets must be equals to equity plus liabilities. What is our assets? 84,488. So that means the equity and the liability must add up to 84,488. What is the equity? 71,269. 71,269. What is our liability? It's 13,219. All right, so let's add the equity and the liability to see if they balance. It gives us 84,488. So this checks out. Our accounting equation is balancing and is done. Thank you very much.